All righty. Well, Andrew, thanks for joining me today. I'm excited to have this conversation.
Yeah, thank you very much for having me.
I always like to get started by asking guests to briefly introduce yourself. So if you can start with a brief introduction of your background and Berkeley Partners, that would be great. And let us know who you are and what you guys do.
Yeah, perfect. I'm Andrew Holmberg. I'm a partner at Berkeley Partners. We are an industrial operator and fund manager, investing primarily in the light industrial sector across a dozen or so major metros across the U.S. I've been with the firm for, coming on 9 years now, in really a variety of roles. Started off focused exclusively on investor relations and expanded into acquisitions, firm strategy, asset management. So really I've touched all aspects of the company over the last 8 or 9 years or so.
And for our listeners that aren't familiar, can you tell us a little bit about light industrial and the markets that you focus on in particular and why you chose those markets, just so we can get oriented?
Yeah, we're buying smaller unit inside the Beltway industrial, so call it 5 to 150,000 square foot unit sizes that serve really a variety of businesses that want to be closer to population centers. We're focused on the fastest growing major metros across the U.S., where really like the demand trends in light industrial run counter to the supply story. So these are infill assets that are hard to replicate, where you have growing demand and a lot of barriers to new supply. So the markets we're focused on are markets like Boston, Philadelphia, Atlanta, Nashville, places with a variety of demand for industrial space, where you're seeing supply fixed or in some cases actually declining.
And why? What drives the constraint around supply in some of these inside the Beltway markets, as you described them? Why is there not more proliferation of industrial supply there?
It's really just all about replacement cost. So in a place like Boston, you're competing against other uses, right? So good development sites are hard to come by, and if you find one, they're often used for life sciences or housing. A lot of these cities they're short residential housing, and other commercial uses just drive a much higher rent level. And so it just doesn't make a whole lot of economic sense to build this product type. And in a lot of cases, you'll actually see older industrial getting acquired and scraped to build this higher and better use product type. And that really creates a supply demand imbalance that is not showing much signs of stopping, really regardless of the economic backdrop.
Got it. Okay. Well, that's super helpful. Thanks for that overview. We'll come back to some of the supply and demand drivers in a moment. But before we get too far into it, so you mentioned, you've been with Berkeley for about 9 years. Can you give us a preview of what you were doing before you joined Berkeley Partners? And then, let's talk a little bit about the capitalization strategy of Berkeley Partners for all of our listeners.
Yeah, so I started off actually in the secondaries business at Landmark Partners, really going through the recession, and then was with a couple GPs, Longworth Capital and the Davis companies in investor relations focused roles, before joining Berkeley in 2014. So really done a few different things. I was in Boston with those firms, then in San Francisco with Berkeley, and now running our office in Dallas.
Excellent. And so Berkeley Partners, what is the capitalization strategy? What is the kind of structure, the different investment vehicles that you invest out of? And talk a little bit about kind of, where you sit in terms of, core, value add, opportunistic, what kind of risk you're willing to take on and, the duration of your investments.
Yeah, so we've done a series of value add funds. We're on our 5th value add fund. That's a $400 million commingled, investment vehicle. We also have a separate account focused on Core Plus with a major, state pension plan. And those are really our 2 vehicles. We're exclusively focused on this property type. This is all we do. We've got offices in San Francisco, Dallas, and Boston, and then a few other regional offices across the country, investing those 2 buckets of capital.
Got it. And so you're investing out of, primarily out of funds. Sounds like the focus is value add. In terms of, your investor composition, how should we think about the types of investors and LPs that you work with as part of the commingled discretionary fund strategy?
Yeah, I mean, we broadened the base over time, but it's really a lot of like the big state pension funds. But we've been able over time to add some corporate plans, a few insurance companies, some endowments and foundations. But investors often looked at us and said, okay, like we're going to do Prologis or we're going to do Exeter, and we want to pair that exposure. And so, I mean, we've been doing light industrial since really before it was as popular as it is now. And the early investors, that's really how they looked at it. They said, we've already got our bigger box exposure, and we're going to add Berkeley to really provide that, more infill, industrial exposure to our portfolio. But we've broadened it out over time. I think we now see a pretty diversified mix of investors, looking at our funds.
Yeah. And when you think about kind of the envelope, if you will, that you operate from within, are you vertically integrated? What do you do for your asset management, lease up, et cetera?
Yeah, we're fully vertically integrated. So, and when I say that, a lot of people have different definitions of what vertically integrated actually means, but we do our own property management, our own asset management, some of our own construction. And then when it comes to leasing, it's really like a best fit model. So in some cases, we'll actually lease units ourselves. In a lot of cases, we'll use sort of the best brokers in the market. Construction, we do some in-house. And in some cases, we'll partner with, third-party JV partners for more complicated, development and repositioning projects.
Great. Well, thanks for that overview. When let's talk a little bit about the current, market fundamentals. And, I know you mentioned you were at Landmark through the last recession. So, your career spanned the early 2000s and, what is referred to as the Great Recession. We're now in, really interesting and uncertain, an economic and global macro environment. To the extent that there's lessons that you learn, through the last downturns, what are those lessons, maybe kind of some of the war stories, if you will, and then, what advice or how are you heeding those lessons and kind of leveraging your experience moving forward into this current period of relative economic and global uncertainty and instability?
Yeah, I mean, I think the biggest lesson I learned coming out of 2006, 2007 was really like, watching some of the other, industrial groups go through that time. And I think most notably was just like watching how Cal West played out, and a few other industrial groups that went through that. And I think what you learn is that like these properties are relatively insulated from a lot of the economic trends. I think even Cal West, I think the NOI was down 10% peak to trough through the 07-08 downturn.
Can you, sorry to interrupt, can you just quickly opine on, can you explain the Cal West situation for those of us that aren't familiar?
Yeah, this was a portfolio of high quality infill industrial national portfolio built by an operator with a major pension system. It was sold to private equity and levered up substantially, and then ultimately got transitioned to different ownership, through the debt in 07-08. And really, like what I learned from that is, these types of assets, like it doesn't require a lot of capital to run the buildings, right? They're relatively low TIs. The NOIs will decline, but it's not as big of an issue as other property types. Maybe you're down 5 or 10%, but you can backfill the spaces. The demand is there. You tend to have vacancy rates that stay in that sort of 5 to 10% range, even in tougher times. But you've really got to watch your leverage. And I think the thing that we did that I think is actually a little bit different than some of the other groups over the last few years is we really stuck to property by property leverage. We'd finance this stuff with local banks. We'd make sure the covenants were relatively light. And really, you were often paying a bit more for that. I mean, some of the banks over the last couple of years, I mean, they would lend down to 2 to 3% money if you went for more aggressive portfolio financing, but those were often floating rate loans. covenants, a bunch of structure around that stuff. And we generally stayed away from that. We generally did fixed rate, one off, deal by deal, tried to minimize that risk. I think that's, one, lesson that, we really learned. And then I think the thing about this cycle that I think was a little bit different than 06, 07 was just the amount of capital that came flooding into industrial, particularly through COVID. And just making sure we were disciplined on like underwriting that yield on cost to get to at least 6% plus. I mean, some of these deals, you really had like a 1 year window last year where stuff was getting price stabilized right around a 5, very aggressive debt, rapid rent growth assumptions. I think just trying to stay away from some of that stuff where you had to buy it in a bidding war, was important as well.
Out of curiosity, what did your kind of acquisition or disposition strategy look like over the last, call it 24 months when we, from effectively the start through, the end of COVID, if you will?
I mean, we were looking for liquidity as much as we could. I mean, we liquidated all of our Fund 4, which, we did that through a few one-off sales as well as, one portfolio transaction. With our Fund 5, we were a little earlier in the process there. So we sold a couple things and hit the returns, which, were obviously strong, but we were halfway through our investment period. So we sold a couple buildings that were some of the earlier acquisitions when we were just getting the fund going. But we're still fairly early. But I think it was a good time to look for liquidity. And then we were also positioning the portfolio more towards what we consider like infill coastal market locations, just because we looked at it and said like, well, as long as I can continue to push rent through good times and bad, I'm a believer in these types of buildings and the supply demand story that we talked about at the beginning of the show. And so I think we tried to position to actually more defendable locations, even if that meant, price per pound was a little bit higher or whatever it might be. We positioned more to like a coastal market like a Boston, where we believed you could push rents really regardless of the economic backdrop, just because of the supply demand, and went much deeper there than, let's say, some of the more outer suburban locations and some of the growth cities, where you've done well in all those areas. Those are great growing markets. But we just felt like on a risk-adjusted basis, you were actually even better off like going deeper coastal, when the market got really aggressive.
That makes sense. So it sounds like, coming out of the global financial crisis, one of the lessons learned was, or one of the takeaways was to, focus on financing on an asset by asset basis. Are there additional kind of lessons that you learned or key takeaways from prior downturns that you're applying to the current environment?
I think that's the big one. I mean, also, have plenty of reserves, make sure you're managing the fund from a portfolio management perspective appropriately. So, you're re-underwriting, making sure you've got reserves to deal with the tenant move out or, a refinancing event, never sort of get stuck having to go back for rescue capital. I think that was a big lesson from 07, 08. And then, I think conservative financing and making sure you have banks that you can pick up the phone and call them and work with them. And, I think those are really the two key lessons.
As you think about the market now, one of the things you mentioned is there was a ton of capital that, poured into industrial during COVID, but there's also kind of more capital in the system, I think, than we've seen at any point in prior history. How do you think about kind of the next 12 to 18 months in terms of, opportunities for the sector, through the lens of what Berkeley Partners is focused on?
Yeah, I think industrial is going through some permanent shifts. I think that you can take lessons away from 07, 08 when it comes to financing and how you do portfolio management, reserves, and all of that. But I don't think industrial looks the same as it did then. I think that we've seen more capital coming into the asset class. I think as you continue to see technology become an issue for things like office, industrial continues to be a beneficiary of that, whether that's e-commerce or really even other types of uses that are coming in and driving demand for industrial space. And capital is also looking for industrial because it's more stable. It doesn't have some of the digital disruption that retail had first and office is having now. So I do think industrial is permanently in a different place than where it was. I think the big shift we've seen in the last year or two is, just the change in interest rates so far. So, you rewound, you could finance portfolios of industrial at, let's say 2 to 3%. That was driving cap rates down. The rent growth was strong. You had Amazon growing their portfolio rapidly. You fast forward to today, the two big changes are one, like the interest rates are completely different from where they were. Single asset, financings are now 6% plus, which is a dramatic change, for the asset class. And then, secondarily, the big tenants in the market have slowed down a lot, right? The headline tenants, like FedEx or Amazon, have slowed down their take up. Generally, the smaller regional companies, the guys we're leasing to, are still, leasing space. The vacancy rates are below 2%. We're still pushing rents aggressively, I think, across the portfolio. But valuations have to get reset because you're now, just in a much different, financing environment. So I think you're seeing, if cap rates were for, they're now, call it mid fives going in. That's how big of a shift you've seen from interest rates. And instead of stabilizing, low to mid fives, you're stabilizing, 6.5 to 7. That feels like some pretty good opportunity, in my opinion. And I think you just have to be, if you can pick the areas where you think the demand is resilient, because I think first you get the change in interest rates, and then most people would expect second you'll get some fall off in fundamentals as we get a slowdown in economic activity and you get some form of recession. I think it's a big question mark how deep that recession really is. But I think that as long as you're picking locations where you have sub 2% vacancy and the tenants have very little options, so you have really almost monopolistic pricing power, this change in cap rates feels like an opportunity. I think you just have to be very selective and make sure you pick the right locations and the right properties.
And so for you, just to reiterate, the markets that you're principally focused are coastal gateway markets, which include what? Boston, you mentioned. What are some of the other key markets?
Yeah, I mean, we're sort of, if you think of, we're just a very large smile, right? So we're San Francisco, Phoenix, down through Texas, Nashville, Atlanta. We've got a little bit of South Florida, DC, and Boston. And those markets all have economic growth, but they also have, at least in the locations we're targeting, supply barriers. I think, in our opinion, some of the growth markets, particularly with the COVID story, it was all about, people move into the Sun Belt. And that was all true, but I think that also led to very aggressive pricing. And that pushed us over the last couple of years to focus more on markets like the Bay Area and Boston, where, supply demand for industrial is very much in the landlord's favor. I think now with the pricing disruption and the fact that the yields have really shifted, we're looking in all those markets again. And, we did a little bit in Texas over the last few years. I think we're looking a lot more here now that those cap rates are up, 100, 150, basis points.
And are there specific macroeconomic indicators that you look for to kind of give you a sign or a signal on the health of, your tenants, market, if you will? I know you mentioned previously, if you can get monopolistic pricing and you can operate in markets where there's not a lot of other options, you feel pretty confident in your ability to lease up these assets. But are there anything that you kind of keep a close eye on from a macro perspective that will lead you to believe that, things are going to get materially better, materially worse?
Yeah. I mean, we're tracking. We're looking at all the major high-level economic indicators. So, GDP per capita, population growth, individual household income, et cetera. I think the big thing is pairing that with forms of supply constraints, so density. So we'll look at like construction that's happening around the property. We'll look at industrial supply per person. We're looking for areas where you're permanently going to be undersupplied for industrial and really focusing on those locations. I think the thing that I'd be the most concerned about today is really housing. And so I think I think in the short term, as long as the Fed is raising rates and making mortgage rates and placing mortgage rates at a place where it's almost impossible for people to justify selling their old home and moving into a new house, housing is going to be under pressure. And I think you want to avoid locations that are overly correlated to the housing market. I think that's the biggest thing we're watching today. And really focusing on areas where you've got a diversity of demand drivers and really demand that's going to be secular and not cyclical. So I'll give you one example. So I've talked about the fact that we bought a lot of product in Boston and we like that market. We can talk more about that. But we just bought a 3-building portfolio in Phoenix. And historically, you'd say, okay, well, Phoenix, that's cyclical, that's housing, et cetera. But 2 of those buildings were right on Intel's campus in Chandler. They're going to put $30 billion into building a new fab that they're partnering on with Brookfield. These are 2 standalone 30,000 square foot, higher power, good clear height buildings, sitting right up against one of the country's biggest infrastructure projects. That demand that's going to drive, you've got Chandler's also a rooftop driven area. You've got high end retail. You've got a lot of houses. That demand for that space isn't going to change if the housing market goes down 15 or 20%. That project is going forward. It's going to drive a lot of demand from service providers that want to be close to Intel's big project. And then the other building was right next to Sky Harbor, the airport, 30,000 square foot, 24 clear building, right near Sky Harbor. You're never going to replicate that product type. That whole area is just becoming more infill. You've got the airport that's going to drive demand. I think that's what we're really looking for, where the demand for the space really doesn't have a whole lot to do with, is housing going down, or are we going into recession? These are really secular drivers of long-term demand. And I think if you find that, you should be willing to make that bet, across market cycles.
Yeah, that makes sense. I appreciate the the example. I think, Arizona is a market that I think is often, misunderstood. So it's interesting to hear kind of how your strategy dovetails with kind of broader macro growth drivers in the market as well. So appreciate the context there. Let's change gears a little bit. You and I first got to know each other, when we were talking about kind of some of the evolving needs of investors and what that means from an investor relations perspective. Because as you mentioned, you started your time at Berkeley focused mostly on investor relations. Can you talk to me a little bit about kind of what's your take on how investors' demands have evolved over your career, and anything in particular that you've noticed that's different about this cycle than prior cycles from a LP or an investor demand perspective?
Yeah, when you say demand, do you mean product demand or demand for things like investor services and transparency and things like that?
Let's talk about both. So, let's finish the economic conversation with product demand, since, you've got product that's historically been in demand. And then let's move over to demand in the sense of what they're requiring and what their expectations are from a reporting and a servicing perspective.
Yeah, on the first side, investors, I think, continue to look for specialized, focused groups that have differentiation in deal sourcing and execution. So, we all know we're in a much tougher time than we were in a year ago, right? The stock market's been down. There's going to be distress in commercial real estate. I think investors that we talk to, they're obviously looking for a way to take advantage of that, but they're also looking to partner with smaller groups like us that are focused on a niche like industrial, that they think where they have a hole in their portfolio and they think that there's going to be long-term opportunity. So we continue to see pretty good demand for what we do in the investor world. And just the size of the funds we're raising, our last fund was 400 million, maybe the next one's 500. They're still relatively small. So it doesn't feel like for what we do, we're seeing much of a pullback from investors. They do feel very cautious. They're obviously looking for ways to take advantage of the disruption in the market. But it feels like for the right niche strategies, they're continuing to make commitments. That feels pretty different from 0708, where everybody just effectively froze, for a couple of years, dealing with issues. But I'd welcome, your thoughts on that topic. And then,
well, just before we move on, I mean, I think it's interesting because one of the things that the headlines are always referring to, and that we hear from our customers that are in the market raising funds, is some of the larger state pension funds, in particular, are obviously being impacted by the denominator effect, where their private equity and venture capital portfolios, and public market portfolios were sky high, and then all came crashing down, and just the need to kind of rebalance everything has put a pause on the velocity of investing activity. So it sounds like either because you're not actively fundraising, or because you're working with a smaller, relatively smaller fund size and different composition of investor, the denominator effect hasn't had a material impact on your current business activities. Is that a fair assessment, or are you also kind of hearing about the portfolio rebalancing that's going on?
Yeah, no, you're probably right. We're not actively fundraising. I'm probably just overly optimistic, I suppose, too. That's gets you up in the morning and keeps you working. But when I think you're right. I mean, we're not actively fundraising the market today, so we're not hearing those discussions directly. We've got a small investor base that we talk to. And amongst our existing investors, they all feel like they've got room to continue, expanding their industrial portfolio, and are looking for, they all seem to be looking for more industrial. I think you're right about the backdrop. It'll be interesting to see when we actually get out there and start fundraising. But so far, the discussions around, continuing to make investments has been fairly positive.
That's great. Well, I think, industrial is an interesting space, as you know. You don't need me to tell you, and you and I have discussed this in the past, but, it went from being a relatively obscure, very niche, very alternative asset class, half a decade ago, maybe a decade ago, to what most would consider mainstream today. And you have your very large operators, some of whom you've referenced already. And then you have really, really teeny tiny operators that have a great portfolio, but they don't have any institutional pedigree. Their reporting and systems may not be up to standard. And so Berkeley Partners and some of your peers fill a really important void where you can be that institutional quality partner, and safe, if you will, for institutional LPs, and get them access to an asset class that maybe they could only get access to through the public markets or through very large investment managers who are, maybe more diversified or just operating at a different scale. So I think it's an interesting area that you all play in.
I think that's 100% right. I think that's probably more what's going on, because you think about industrial, like if you're not investing with the big guys, there's probably really only a handful of groups that are actually raising funds. I mean, that's pretty different from multifamily, where, how many value add multifamily groups are there? Maybe 15 or 20, if not more. Industrial is probably half that.
Yeah, it's just relatively newer as a mainstream asset class. So let's talk about investor demand. So, we talk about reporting, we talk about transparency, we talk about accessibility. Kind of what's your take as a, someone who's been rooted in investor relations throughout your career? Like, what's your take on how that's evolved? And then, let's talk a little bit about what Berkeley Partners' approach to client service and investor reporting is for your LPs.
Yeah, I think as we all know, the demands are growing. I think the biggest shift we've been seeing over the last year or two is really around ESG, just continuing to figure out really how you track and report on that. And I think investors are really focused on that and want to understand how you're meeting not just environmental, but also things like governance and diversity of the team and all of that. I think those are the biggest shifts we've really seen in the last couple of years. And we are pushing hard to meet all those demands. It isn't easy to track all of the environmental items. When you get into things like industrial, you're tracking, water usage and energy usage, but it's important. And I think the investors, want to see it and at least want to see that you're trying to report on it. I think otherwise, we saw a big shift over the last 5 years that really you guys were at the forefront of just providing, better documentation, better reporting, more transparency. I think that played out over probably the last 5 or 6 years. It feels like we've got a pretty good handle on that at this point from an organizational standpoint. Now we've seen a much bigger push on the ESG side. I don't know, is that consistent with what you've been seeing, or how have you been seeing it play out?
Yeah, no, I think that's very consistent. I mean, over the last, 5, 6 years, there's been a, significant push to close kind of what we call the transparency gap. And transparency can, some people think it's a bad word, but I think, by and large, most people accept that, in order to be a good fiduciary, you need to be prepared to share kind of a minimum level of information with your investors. And so, whereas in 2014, 15, 16, very few people had investor portals that allowed their investors to contextualize the investment. Today, if you don't have that, then you're actually kind of have fallen behind versus at the bleeding edge. And, very similar to the feedback that you just provided, we're seeing a really substantial push around, ESG, specifically from European investors and some state pension funds who have made commitments to, minimum requirements over the next, 2-3 decades. And so a lot of people are trying to figure that out. And it feels a lot like 2014, 15, 16 from a quote unquote investor, performance reporting perspective, which is obviously the space that we play. So, I think the market would largely agree with your perspective. How do you, just out of curiosity, like, how do you think about, closing the gap between where you are, or maybe there isn't a gap, but how do you think about evolving your ESG reporting specifically on environmental? Are there different tools that you use, or, key people that you've hired, or how do you think about that inside of Berkeley Partners?
Well, we're pushing on it hard right now. I mean, I think that is the biggest challenge for smaller firms, just because of resource and time focus. But it's very important. So, I think there are various third parties, but it's really about actually tracking the activity at the individual buildings. So, putting on solar where you can, tracking power usage, water, doing LED lighting upgrades, right? Those are the types of things, and then really just tracking and reporting on it on a regular basis. But it feels like it's becoming an essential. Maybe it's only some investors that are asking for it at this point, but it feels like for the next few years, it's going to become a must do.
And what is your general approach, right? I mean, a lot of people say, well, investors are asking me about it, but they're not requiring it, so I'm not going to touch it. And others are saying investors are asking about it, and so I'm going to use that as an opportunity to start to develop, a methodology and a skill set around it, because I want to do it whether they require it or not. Where do you kind of fall on that spectrum? Or maybe it's, somewhere that I didn't mention on the spectrum.
Well, yeah. I mean, fortunately for us, like some of our big investors do require it. So then you basically do it for everybody. So I think we're being forced. Well, forced isn't the right word. We are, some of our bigger clients, we have to do it for them, and that's pushing it all the way down the organization. But it's the right thing to do. I think you just work with the right third parties. So I think what we're doing is, every building you're going to do LED lights as long as it makes economic sense, right? You're going to do solar, on the roofs where appropriate. You're going to do tracking of power and water, right? There's various third parties that'll actually go through your entire portfolio and set all of that up. And then you're going to report that as frequently as you practically can, hopefully quarterly, if not semi-annually to your investors, and then, track it over time. Um, I think that's really what you can do. And then, you know, obviously on, governance, there's a number of things you can do as well. So I think that's what we're doing today. We'll see, if it's enough.
Yeah. I mean, look, I think all the conversations that I have with many of your peers are largely the same. I mean, it feels a lot like when we started, Juniper Square and got into the market. There's a high degree of interest in collaborating and evolving, and varying levels of both sophistication and tooling to help support that. Right? I always talk about is it skill or is it will? And it sounds like you have the will to do it, and you're developing, or not even you, but the market is developing skills around how to be, how to keep up with the evolving needs of your investors, starting with financial and performance reporting, and now evolving over to ESG reporting, and who knows what might be next. But I think it's just important to realize that these are iterative processes, and the way to make progress, and what we saw in the financial reporting side, is it needs to be collaborative. It can't just be GPs doing it because their LPs are requiring it without partnership. The LP needs to come to the table as a solid partner. The GP needs to be open to evolving. We need to understand the risks and the rewards on both sides. And then we need to develop kind of the ecosystem and the muscle in order to facilitate this type of work.
Yeah. Do you think there'll be like other emerging investor trends that we haven't thought about? Like for example, like we have a few construction projects that you can actually 24/7 go on the cameras and see the progress on those buildings. And obviously we all have access, but our investors don't. Do you think there'll be things like that where, your investor portal could do like a 3D walkthrough of the buildings or something along those lines that even could get the investors even more connected to what their GPs are doing on a day-to-day basis?
Yeah, I mean, I think it's a great point. I think what we've heard from groups that we speak to are, number one is the technology has evolved. COVID really drove this rapid acceleration of technology that enabled better visibility into the asset level performance, the physical envelope of the building. And so now that we have tools that allow you to do virtual lease-ups, virtual walkthroughs, people had assets that were fully permitted during the pandemic where nobody visited them. Then the second end of that equation is, how do you take those tools and that technology and pair it, with the user experience that makes it easy for investors to consume? And so, in the Juniper Square portal, for example, we have the ability to support high res, photos and videos, which helps when you're thinking about quote unquote contextualizing the performance of the investment. Because now when you're marketing a new fund or you're acquiring a new asset, the ability to kind of plug in some videos to start with is a nice kind of easy entree for investors to be able to understand. Because the reality is there's still a gap. There's tools that you use to run your business better and business more efficiently and make better investment decisions. And then there's investor behavior, and that's still evolving, because the reality is, as you know, many of these large state pension funds and others are really kind of staffed quite leanly. And so the ability to both utilize the technology and to consume and kind of internalize the benefits is something that I think the market still needs to take up. So, we saw this with hybrid annual meetings. It used to be only in person, and then it was virtual, and now it's a combination of both. But, the main trend that we're seeing, specifically around these new evolutions, is how do you think about running your business more efficiently, right? It's all about efficiency. And obviously, one way to do that is around, outsourcing of, different tasks, whether it be your fund accounting and administration, or, different tasks that, firms might do in-house today, and then augmenting that with technology to allow the people that you have the ability to do more. So, I think it's a really interesting space. And, we've talked about this a lot, Andrew, but, not long ago, it used to be real estate and technology. And the reality is today it's real estate. And in order to be in real estate, you have to utilize technology across all different facets of your business.
Yeah, completely agree.
Awesome. Well, it's been really great having this conversation. Before we let you go, I like to ask everybody to share kind of one prognostication, if you will, about what you think the next 12 months will hold. So if you have to look into your crystal ball, what do you think the next 12 months will bring for the market?
Well, I think this is going to be. I think this is going to be a start stop, or excuse me, a stop start next 12 months. So I think everything will effectively, if you cut off all the credit to the economy, we will have effectively a stop. But I think people will be surprised at how quickly, once you get enough of like a turn from the Fed and inflation feels like it's under control, I think we will be surprised at how quickly we come to a stop and how quickly we then start back up again. And I think that's going to make it, very interesting, next 12 months.
Let's hope the start comes very quickly after the stop, and it's a short little stop. So, anyways, Andrew, thank you so much for joining me today. It's been great chatting with you, and as always, appreciate your time and insights.